Welcome to Heritage's investment update for the first quarter of 2022. As we sit around the tax date right now, I wanted to mention quickly that calendar year 2021 was a very strong investment environment. And when you have investment portfolios that do extremely well, you do typically have gains experience and higher taxes than what you're used to. We've seen that across the board. As we look at investment returns in the first quarter, you should take a look at the circles, and you'll see a few dramatic things. First on the left is fixed income returns. A negative 5.9% quarter for core US bonds is actually an extraordinarily unusual event. Bonds have gone down quite a bit as we've seen interest rates rise from the beginning of the year, and we'll go over this a little bit later. High yield is down, foreign bonds are down, and emerging market debt is down more than any of the above. With all of this together, fixed income did not provide the principal protection that we've seen it provide quite regularly over the past multiple years. When we look across equities, you also see a tough start to the year. From the US large cap market that was down 4.6%, all the way to emerging markets that posted a negative 6.9 for the quarter. Equities did not do well. The one savings grace for the beginning of the year was real assets. Real assets is a position that we've built in client portfolios. And as we see higher inflation, we do see these assets performing positively for the year. 1.5% for a quarter isn't an extremely exciting return, but this was the place to be, and it is a place that we've added to. Now, if we take a look out for the trailing 12 months, so since the end of the first quarter of 2021, you can see that quite a few markets are now negative. You're negative across bond markets, you're negative across emerging markets, you're negative in the small cap space, the US market. But there are still areas of positive returns for the year. Notably, the US large cap market, that's still up 14.3% on a trailing 12-month basis. And real assets, again, up 13% over that period of time. Having a diversified portfolio that has significant assets in US equities and real assets and in some developed international has made it so that you haven't borne the brunt of some of the markets that have performed less well. Now, you can't think about the first quarter of 2022 without thinking about the Russian invasion of Ukraine. And while we do believe that over longer periods of time, geopolitical events can have an impact on markets and do, over the short term, you typically see a sell-off and then a recovery. So you'd have to go back to the 1970s to see a period of time where it took longer than a couple of months to reach new highs after a military conflict started. So volatility around these events tends to be relatively short-lived. The long-term impacts really depend on how the event plays out over time. So you could think about the 9/11 attacks and the Iraq war as still having implications on the fiscal situation in the US. However, you could see things like the Soviet invasion of Afghanistan, where after some initial volatility, being invested for a period of time after that was obviously a good move for a portfolio. So while we do see a sell-off after these events, averaging about 6.5%, you typically recover that fear-driven selling relatively quickly, and then markets move on more fundamental factors, which we should take a look at now. So as we look at how our investments priced today, we do see plenty of opportunities that look about in line with historical averages. So again, we've played this theme before, but the US large cap market, its current price to earnings ratio is higher than its long-term average. And you could say that that is consistent with expected lower returns going forward. However, as soon as you get out of the large cap growth space, you can see that there are opportunities elsewhere. In large cap value, we're actually trading right around the long-term historical price to earnings multiple. We're at a 15. That has a no growth 7.5% return associated with it. That seems perfectly normal. Small caps are actually priced lower than what their typical price to earnings ratios are. Small cap space, some might argue, could have larger growth potential in earnings. So that's an area where you can actually get excited about making investments. In international markets, we're trading just under the long-term average at a 13 PE, another healthy price point to be buying in at. and emerging markets priced at about 11.7, which is exactly on its historical average. Emerging markets, you face volatility. We've faced volatility with the position multiple times, but over the long term, you tend to see superior performance because of the low pricing relative to what the companies are producing fundamentally. Now, another story that you have to touch on in the first quarter of 2022 is inflation. Annual inflation readings have been 7% or more since December of 2021. We've recently surpassed 8% annualized inflation. This is the highest level since back in the 1980s. High inflation is something that can be very disruptive to businesses. It's associated with the Federal Reserve changing its policies to try to control prices. And when the Federal Reserve changes its policies by increasing interest rates, you can have a pullback in business activity, you can have a recession, and you can end up with a stock market pullback. So that's why folks, I think, mainly are worried about CPI going up from an investment standpoint. And then, of course, you face the higher cost of goods when you're actually spending. So when we take a look at the Fed, you can see that very short-term interest rates are still quite low. They've ticked up just a tiny bit, but expectations are for a very rapid set of increases over the short term. And finally, the market is actually buying into these increases. So in the chart below, you can see the estimates by the Federal Open Markets Committee that says they're going to increase rates up to about 2.8% over the relatively short term. And you can see about 1.9% built in just over the course of this year, 2022. Now, the market is right in line with it. So you can see that the Fed has gained some credibility, that the market does believe that they'll increase interest rates, and the yield curve is adjusted to reflect that. Long term, the FOMC projects interest rates at about 2.4%. That's a fairly easy long-term rate to think about, because if inflation hits about an expected target of 2%, it gives you 40 basis points in real return for delaying consumption. And that's 10 basis points off of what your average real return would look like. So let's take a look at what has happened with interest rates over the course of the year so far, why bonds have performed so poorly, and what we're likely to see going forward. I want you to pay attention to two of these lines in particular. The first is the orange line at the bottom. That's the December 31st, 2020 yield curve. And you can see where it is right now with the blue line. So a dramatic change. Now, short-term rates have actually not changed all that much. If you look at the very beginning points on this graph, that's up very modestly at the ultra short term. However, you very, very quickly get a steep portion of the yield curve. You've seen that long-term rates have adjusted already to believe that the Fed's going to get off of zero and get off of zero relatively quickly. And then you get a flattening out just as you pass the 3-year point. And it's basically a straight line after that. So the market expects rapid increases in interest rates over the short term, and then it expects a moderation where it roughly would be flat at a terminal rate of 2.5% or so. So if we think about this, you could hold short-term debt right now that would be earning very little, but you would expect as that debt matures and rolls over that it would be able to invest at new short-term rates, and those short-term rates would continue to grow, and you'd end up with a return that actually is reasonably high compared to current cash rates if you do that over the course of multiple quarters. Conversely, you can push out a little bit. Now you can get yields on relatively short-term notes that are up in the 2% range. That's getting a little bit more attractive. And then as you push out further, yes, rates have risen, but not to a point where you'd say this is a historically very high level for rates. You can see in 2013, everything 10 years and beyond was well above where current long-term rates are. I mentioned real assets, and this really has been a success story here. It's an area that we, again, have added to over the course of the past couple of years in portfolios, and the story's worked out very nicely. The idea with our real assets allocation is some stability. You've got stable properties that produce income, that have a yield to them that's somewhat bond-like, but doesn't tend to have the volatility that stocks have, and tends to receive income that is moving along with what generally feeds through as inflation. So if you look over the past 12 months, you can see the roller coaster ride in stocks. Stocks were up more than real assets over the course of 2021, but then of course they started their sell-off in 2022 and have ended at a positive 6.14. But boy, you've touched some tough levels and faced some volatility. Bonds, while they do provide stability, you can see that while that line is not as volatile as stocks, it's ended down. So bonds, especially term bonds, when you've had rates go up, have been an area that has hurt some investors, and it hasn't for quite some time. If you've been in short-term bonds like we have, you've fared much better than the overall US bond market. But then you look at real assets. Real assets cumulatively over the past 12 months is up 15.56%. You can see the steadiness. It's much more similar to the bond line in terms of the ebbs and flows as it's moved up. And that's been an area of real success, a real buffer in the portfolio, and a real good case for diversification. I appreciate your time for this quick update. Hopefully the second quarter will see a rebound in some asset prices. We believe that our portfolios are positioned well, regardless of the environment, to be able to provide relative returns that are attractive. Thank you.